After a momentous 2024, what does this year have in store for investors? Today, we're going to look at the drivers of last year's performance and what to expect this year. Has the battle on inflation been won? And managing tech company concentration risk. I'm Dan Boden, Chartered Financial Planner at Abode Financial Planning, and I'm delighted to be joined by Laurentius van den Vom, Chartered Financial Analyst and Head of Investment Strategy at Timeline. Great to see you, Laurentius.
Hi, Dan. Great being here.
So let's dive in. 2024, briefly looking back, strong year in both growth and defensive assets. Would you take us through what were the key drivers behind this strong performance and generally just give your views?
Yeah, I think Dan, there's so much to unpack in the economic growth and the market's performance that we've seen over the last year. First of all, let's start with equities. The slide that you are sharing shows it quite well. First top line shows you that global equities, black line over the last 5 years, 69%. That is quite a phenomenal return over the last 5 years, taking into account that still captures the whole COVID-19 pandemic. Then if you look at the orange line, it goes into a 3-year time period, 26%. And then the green line, the last 1 year returns, 18.92%. That's global equities, phenomenal returns that we've had on the equity side. If you skip the global bonds and you go straight to UK equities and US equities, what you will see is that UK equities have been lagging quite a bit. It's positive over the 1, 3, and 5 year time period, and a 25% over a 5 year time period, or a 19% over a 3 year time period is still not bad. If you look at the last 1 year at 10%, that's what you could expect more or less from global equities on average. So the UK markets haven't performed poorly. However, if you go one down to the US equities, this is where we've seen some phenomenal returns in the US. 5 year returns, 106%, 3 year returns, 37%, and just the last 1 year return was 27% in the US. And the US equities was mainly what was driving global equity markets. And again, probably a particular sub-segment of the US markets. And I believe we will get to that later on in this topic. It's just impossible these days to do an economic or a performance review without touching on these large cap Magnificent Seven stocks. But they were mainly the ones that was driving equities. And that can be seen right at the second last asset class, global growth equities. That's where we've seen strong growth, especially with your companies like Nvidia, Tesla, Apple, Amazon, etc., Facebook. And then also, if you look at your value equities, these are now your equities that we would deem to be on a discount, equities that are very well priced. They are considered quite attractive from a valuations point of view. And these are the ones that you would expect to outperform over the long term as prices or as you can find mispricings in the markets. Your value equities tend to mean revert to fair valuation. And over the long term, value equities have significantly outperformed growth equities. And that's a long-term trend that we could expect to continue. We've now been through a couple of years where value has been lagging quite a bit. And I think 2024 was another one of those years. That said, it still had some significant returns, 15.23%. I think that was still above average and really, really solid returns from global equity. So it seems like the whole equity markets have done really well. There's not a particular part that we can say haven't showed any positive news. I think some of the emerging markets might have been struggling. That might have been the high interest rates that has caused that. But in general, equity markets have treated us really well in 2024. And then just if you go to the second asset class from the top, global bonds, that's now your defensive asset in your portfolios. That's your asset that you would expect not to be negative. It's your asset that when equity markets are down, you expect these bond markets to sort of hold up and counteract the negative equity movements. Fortunately, we haven't had any negative equity movements over a sustained period of time over the last 5 years. However, global bonds are still negative. If you think about what happened in 2022, 2023 with the rising of inflation and then quite aggressive interest rates, and then more specifically to the UK as well during the summer of 2022, The bond markets have struggled quite a bit, and we are still seeing some of the negative impact from those from 2022 and 2023. However, over the last year, 2024, bond markets were relatively stable. We haven't seen a massive recovery, but they were relatively stable.
Okay, wonderful. So, picking up on bonds in particular, so there's an inverse relationship between interest rate rises and the price of bonds. So when interest rates shot up, right, the price of bonds fell, and it's not quite recovered over a 5-year period. We'll pick up interest rates in a second, but the said something interesting about UK equities and US equities. Something that we see quite often is clients who perhaps have been looking after their own portfolio, managing their own money. They tend to have a more UK bias. So there's a familiarity bias there. So they might have set their portfolio up with a slight overweight to the UK market. So what we're seeing here, based on these figures, that actually, if you've been overweight to the UK, you might have missed out on some of the global growth, perhaps in other markets, namely the US. So global growth, global value equities as well. So we're thinking growth equities. So like you said, Nvidia, the large tech companies, strong balance sheets, typically not dividend paying, quite innovative industries. And value equities, we're looking at kind of unloved by the market, unsexy industries. So thinking banking, utilities, that kind of ilk.
Yeah, that's right. You're spot on, Dan. If you think about your value equities, those are typically your equities that doesn't get all the limelight, because if it gets all the limelight or all the shine in the market, investors will start to price in the future prospects. And that's what they are
Okay.
doing with your growth stocks. That's what they're doing with the likes of Nvidia, Tesla, Apple, even to a lesser extent, Alphabet, or well, more commonly known as Google. Uh, Future profits are being priced in. Now, if that happens, then these companies need to deliver on those promises of future profits or those expectations of future profits. Your value equities is sort of outside of the limelight. Those are your equities that are just doing their normal day-to-day activities behind the scenes. Those are the ones that are generating the usual cash flows. It was usually more mature companies, not necessarily, but usually more mature companies. So think of your defensive healthcare companies, financial companies, commodities, utilities, even property tends to be somewhat value orientated. And these are solid investments. And historically, they have been slightly more stable, but they've also outperformed growth stocks on the upside.
Okay. And do the value stocks, so we're looking historically, long term, they've shown outperformance over growth stocks, but do they go through periods of underperformance versus growth stocks?
Absolutely. So I think the one thing that we've now seen over the last 10 years, and people often ask us, uh, will the value premium return? And the value premium basically just means the fact that value stocks over the long term outperforms growth stocks. Will it return because it hasn't happened over the last 10 years? And the reality is, if you take a longer term view over the last 100 years, what you will see is that we've actually had these 10-year periods of underperformance quite regularly. It's not a new phenomenon. And it just shows us that all these cycles come and go and it can be quite extended. It can be 10 periods, it can be 12, or sorry, periods of 10 years, periods of 12 years, or even longer. But usually what would happen is these risk factors or these premiums will show up quite aggressively and outperform your growth stocks. And it also is a great tool of diversification. If you think about your growth stocks, they're pricing in future profits. What happens if there's a recession or an equity market downturn? Those are the ones that usually correct themselves the most aggressively, and your value stocks are your more resilient stocks. So it's not just in bull markets when you would expect value stocks to outperform, but it's actually when markets are down that you'd also expect value stocks to outperform. And we've been now through an extended period of very positive sentiment in the markets, and that has definitely fueled growth stocks. But I think there's definitely a very optimistic case to be made for value securities um, in the next couple of years.
Okay, excellent. And so something that would invariably have a big impact on both growth assets, as in global equities, and defensive assets like bonds, is inflation. It was promising signs last year that the battle of inflation was won. And what might investors expect from central banks this year, and how might their decisions impact both equities and bonds?
Yeah, that's an interesting question, Dan. I think there's a general consensus out there of what would happen. We've seen inflation come down from where I think that the peak was, it was 11.9 or 11.1% in the UK, has come down to about 2.6%, 2.7%. It has reached a low of 2.1 and then sort of re-emerged slightly. That's to be expected. Inflation doesn't come down in a straight line. It is quite cyclical. Going forward over the or looking forward towards the end of 2025, we don't see significant changes in inflation, and there's a few reasons for that. One is economic growth. It seems like economic growth might be relatively stable compared to what we were used to the previous years. That will definitely spark more sticky inflation scenarios. I don't want to say it will spark inflation again, but it will cause inflation, or it will make it very difficult to get inflation at least below the 2% target. And I think that's a global phenomenon. What you can see on the slide as well is your predictions towards the end of 2025. Your consensus predictions is that the US will be 2.5, the European Union 1.9, UK 2.4. So all of them, except for the European Union, um, slightly higher than target. Then, if you look at the Chinese economy, they actually have a threat of deflation, prices going down, and that is actually quite a significant threat. I think the consensus view is for China to have inflation at about 1.4%, which is not a good thing. If you look at what the target is in emerging markets, they're usually targeting around 4 to 6%, because inflation also stimulates economic growth. And these emerging markets need some form of inflation in order to stimulate economic growth. So 1.4% for China is also not a great sign. And then in Japan, 2.1% inflation target. That's actually a very good sign for the Japanese market. They can finally increase their rates slightly, not significantly. They've been in a negative interest rate environment now for quite a long time period. And going from 0.5% to 1% is really positive signs on the Japanese front. Just taking one step back to the Chinese economy, if you look at emerging markets as a whole, I think we just have to be very careful to take China as sort of the proxy for emerging markets, because in the emerging market space, we are seeing both sides of the spectrum. We see the risk of deflationary pressures, but we also see the risk of hyperinflationary pressures. If you think about what's happening in Argentina, Turkey, even. But in general, most emerging markets seem to have inflation under control, very close to the 5-6% range in general.
Okay. Interesting about China then. It doesn't seem things are going swimmingly well then in that sense with the threat of deflation. But thinking about a global investment portfolio. So China, huge country, second largest economy in the world, huge population. How big and how impactful is China on an investor's portfolio? How much of a globally diversified portfolio would actually be invested in China?
Well, the Chinese economy, if you think about the size of the Chinese economy, the second largest economy in the world, um, they are influential from an economic point of view. If there's some detrimental economic news in the Chinese economy, it might ripple through to the Western world. From an equity market point of view, they are slightly more controlled. They are not as open as the rest of the world to invest in. So, if you think about the exposure of China in a portfolio, it usually sits within your emerging market section of the portfolio, which tends to be between 12 and 20% of your portfolio. And China would make up about 30% of your emerging market exposure. So if you think about that, it gives you an exposure of between 4 and maybe 8%, but not usually not more than 8%, probably closer towards 4% of your total portfolio. So not a
Okay.
significant exposure to China itself, but then again, it is quite a significant country in terms of economic strength and just pure influence. I mean, if we, it's still quite fresh in the news, and I'm honestly not up to date with everything. But if you look at what's going on between Nvidia and DeepSeek, where the Chinese economy or company in Chinese where China were able to sort of challenge Nvidia with an investment of $6 million. So there's quite a strong influence on the global scale from the Chinese markets. It's more than just the actual allocation that you have in your portfolio.
Okay, good stuff. And so, thinking about inflation and the wider policies of, say, for example, the US, everything I'm reading suggests that a lot of the tariff policies are inflationary. So, are those policies baked into these figures, or
Some of the tariff policies will be baked into these figures. These figures were usually are mostly or were mostly constructed before President Trump came into office. But there were definitely threats of tariffs coming in, globalization or deglobalization, or reshoring or nearshoring. There are all these terms basically meaning that we need to sort of protect our own manufacturing abilities and our independency. That is definitely included in what could contribute to higher inflation. Tariffs, just in general, I mean, it's a cost that needs to be paid. There's no way that a tariff can make a product cheaper, and therefore it cannot have a positive impact on inflation. Without stepping into politics and the outcome that tariffs can have, I think the general consensus is there's a cost that needs to be paid, and if there's not excess profit margins to pay those costs, it will come down to the consumer paying those costs.
okay, okay. And are there any other policies or directions, both in the UK or the US, about the new administrations? What might some of the policies from the new government? How might investors brace themselves for these changes?
What can we expect? It's always interesting because you've got about half the population being extremely positive about these changes, and then the other half of the population, understandably, not positive about this situation. And that's just the outcome of a democratic election. So I think, if anything, as an outsider in the UK economy and in the US economy, or in the US government and the UK government, I see it as a positive sign. Um, that there's some new governments taking over. Um, I think, what can we expect from these governments? We know the Trump administration is quite provocative when it comes to tariffs. Will that cause heightened volatility in the markets? Absolutely yes. But then we also know sort of Trump's success gauge is the S&P 500, the largest 500, technically 506 companies in the US. And given that that is Trump's success gauge, he will do everything in his ability to sort of try and keep the stock market in the US quite high and breaking record highs as he goes through his 4-year term. So I think it's impossible to say what will happen over the next 4 years. It's possible for equity markets to just continue with their on upwards trend, but we can expect some volatility as well.
Okay, well, staying with the US a moment then. So, a year of outstanding growth, as we saw in the earlier slide, 27% with the S&P 500 in the US. Now, around a third of the US stock market is the 7 huge technology companies. So, if they continue to grow, great if you're in a well-diversified portfolio. But how about the risk of the concentration of these? So if they make up around 30%, if one of these companies has a terrible day or a terrible year, that's going to impact investors, right? So first of all, how might investors balance their portfolios so to benefit from this growth of these huge behemoths, but not be too overexposed?
Yeah, that's a great question, Dan. And I think to usually answer this question, I start with what the market tells us in general. We believe that there's something to be said about the market being efficient. If you take all the active decisions of all your smartest fund managers in the world and you pull them together, then you get the market. And it's this market that have decided that these magnificent seven companies should be about 30% of the US stock market. Because what they do is they analyze the companies. They do see that these companies have significant potential to generate profits. They have proven their potential to generate profits, especially companies like Apple. Tesla looks promising. Nvidia looks really promising. Even Meta these days looks quite promising, and that wasn't the case, well, let's say about 3 years ago. So we have to have some trust in the markets that the global or the collective wisdom of the markets cannot they cannot all be wrong. That said, you've made a point about concentration risk, and that's a reality. If you just think it back again to what happened yesterday, what was on the 27th of January with DeepSeek, the Chinese large language model, um, posing a threat to NVIDIA. All of a sudden, NVIDIA dropped. I think there was about $600 billion wiped out of the market just from NVIDIA alone. Looking at your larger tech stocks, there was about $1 trillion wiped out in a single day because some small company in China
Wow.
posed a threat to Nvidia, and that is quite significant. So yes, there are concentration risks in the market. Seems like Nvidia now, as I've opened up a few hours ago, seems like there's a massive recovery again, and some of the negative sentiment or the hypes was maybe overhyped. Um, so, but I think the point that I'm trying to make is that there will be concentration risk as soon as you concentrate into certain companies too much. Are we concerned about it? The short answer is not really. We do think the markets are quite efficient, but there's also a case to be made to sort of diversify away into what we've discussed earlier, risk factors or risk premiums. And what you can do is tilt your portfolio towards companies that are undervalued, tilt your portfolio towards
Okay.
companies that are slightly smaller, and that will naturally diversify your portfolio away from these large mega cap stocks without selling out of these stocks entirely. And I think that's the key part. If you're going to diversify, just tilt your portfolio. Do not exclude these companies entirely because that will be a risk in itself.
Lastly, it'd be amiss of us not to talk about crypto and specifically Bitcoin smashed through the $100,000 barrier last year. So generally, just give us some of your views on this as an investment and briefly discuss some of what the risks are.
Whoa, Bitcoin. It's an interesting topic, and you can go on for ages about it. I think, in short, our view at Timeline is be careful. Do not put anything more into Bitcoin than you are willing to lose. We've seen Bitcoin, yes, it's above $100,000 now. We've seen Bitcoin losing more than 75% of their value two or three times now over the last 12 years. It's probably closer towards the last 10 or 8 years. So we've seen Bitcoin having significant drawbacks. The volatility of Bitcoin is a magnitude higher than the volatility of the S&P 500 in the US, and that is still quite high. So I would be careful of Bitcoin. We don't see it as an asset class. If anything, you'd probably see it as a currency. Has the price created a lot of wealth in the world? That is debatable. The price has definitely increased. I would like to meet somebody that bought Bitcoin at $1 and still has it now. That's north than $100,000. I'm sure there are some of those people that have done that. I would be very very wary of Bitcoin. Quite an interesting thing was I read the other day about the percentage of retail investors that bought Bitcoin and what their average profits were, and the answer is negative. The average investor in Bitcoin is down or have negative returns because it's all about timing. I think that is why I would be very, very careful to invest in Bitcoin. And if you do, just make sure that you don't invest any portion of your assets that you are willing to lose into this asset class or into this. I think the key takeaway here is just that make sure your financial plan is in order. Make sure your financial plan is grounded in a globally diversified, low cost, evidence based investment portfolio. And if you then have some other cash on the side that nobody knows about and you are willing to lose them, that's on you. But at least make sure that you and your family or your financial plan is secured, and don't try to do that with Bitcoin.
Excellent. Magic stuff. Well, thanks so much for your time, Laurentius. We'll get back to this perhaps 6-12 months time and see how right or wrong we were about the outlook for this coming year. But thanks again.
That would be interesting. Thanks, Dan.